Hi, good morning, everyone. Thanks for joining us again for today's weekly morning call. Today we have a few stock counter updates. We have Sessa REIT, site visit note, ST Engineering initiation, as well as some affiliate on the ground and a number of technical analysis and the usual Singapore weekly. So without any further delay, let me hand over the time now to Miao Miao to talk about Sessa REIT site visit. Miao Miao, please. Thanks.
Thank you, Darren. Also, we visited the outlet malls in Chongqing, Liangjiang, Chongqing Bishan, and Xi'an during Sessa's anniversary sales. So, few highlights for the set visiting. Firstly, the sponsor shared that outlet sales at the sponsor group level were very robust. Sales for the past 9 months have outperformed the entire year of FY23. Of FY22, with the Chongqing Liangjiang outlet mall being the top contributor, and domestic brands contributing for around 70% of the sales. Nike, Adidas, and Plus 39 were usually the top 3 best performing tenants for Chongqing Liangjiang and Xi'an outlets. New brands, including Teeny Weeny for teenagers, Lecoq Sportif for sports, and Amer for luxuries, have also gained popularity among middle-income Chinese customers. We anticipated a 29% year-on-year increase in FY23 sales, driven by Sessa's clear value proposition, which capitalized on the trend of consumption downgrade in China. Secondly, VIP membership at the sponsor group level is expected to increase by 20% to 20 million by the end of FY23, contributing to around 70 to 80% of the total sales. At the portfolio level, VIP membership reached 3.2 million as of first half 23, with a 3-year compounded annual growth rate of 22.6%. Sessa has also adjusted its business model to adapt to several paradigm shifts post-COVID to enhance customer conversion rate and engagement. Sessa has launched online WeChat mini program as part of the omnichannel strategy. We believe that the proportion of online sales has significant growth potential as products have higher exposure with greater convenience to shop, and currently only accounts for a low single digit of the total sales. Meanwhile, Sessa has also extended its operating hours during the anniversary sales to attract more customers and launching various events such as the National Day sales event for domestic Chinese brands. Lastly, Xi'an Outlet Mall is also a sponsored pipeline asset and the second largest outlet mall in terms of sales revenue. The valuation of Xi'an asset is estimated to be around 500 to 600 million Singapore dollar, as it's comparable to the largest asset in the portfolio, Chongqing Liangjiang. With stable cap rate of 7%, we believe such acquisition is DPU accretive with a positive carry of 1.5%. And would raise DPU by 4%, given the EMA rental income would increase by 45%. However, given the current capital market condition, we believe acquisition is unlikely to be done in FY23. Leverage ratio as of first half 23 was at 26.2%, which is one of the lowest among S-REIT. As such, Sessa has no intention to divest any asset. Next slide, please. Yeah, moving on to some photos of the asset. The first one is the biggest asset in terms of sales revenue, Chongqing Liangjiang. As of December 22, VIP members reached 967,000 with 3 different tiers and its own set of benefits. The highlight of the asset is their VIP lounge. The picture on the red bottom is the lounge for the 3rd tier VIP member, which offers free drinks for members to have a rest and then continue to shop. And the picture on the top is for the 2nd tier. Yeah, the place can be booked for personal events. Next slide, please. Moving on to the Bishan asset, it offers various amenities such as the UME cinema, Counter-Strike game, and also the super farm for strawberry picking. Yeah, all the pictures are below. And also there's a recent asset enhancement initiative involved the AI assistant to guide customers and provide the latest offers or promotions. Yeah, next slide, please. The next one is the Rofer S at Xi'an. Differentiate from other outlet malls, it has one of the biggest F&B offerings, which is to bring the traditional Xi'an food from a village into the outlet mall. F&B accounts for 10 to 15% of the total sales, and currently they have 1.2 million VIP members. Sales for the first day of the anniversary sales increased by 15% year-on-year in 2023. Yeah, the target sales in 2023 is RMB 2 billion, with a record high of RMB 1.6 billion last year and generated traffic of 12 million. Yeah, here are some pictures we took. We observed that for the parking lot, which has 1,330 parking space, were nearly full, or were nearly at full capacity, and some of the visitors has to park on the roadside. And the queue to shop at the F&B and also Nike was very long. Yeah, as shown in the picture. Yeah, next slide, please. So conclude the site visiting. Currently, the biggest concern for SESR is the weakened macroeconomic outlook of China. Retail sales nationwide increased by only 2.5% in July 23, which is below estimation. However, the outlet mall industry has proven to be resilient, with SESR Group sales experiencing consistent annual growth rate of 20.89% from December 2019 to September 2023. We noticed that the change in consumer preferences towards becoming more practical and more inclined to spend on experiential and value for money products rather than making some substantial investments such as purchasing a house or car. As such, we maintain our buy recommendation with unchanged DDMTP of $0.9. As at the current share price, our FY23 to FY24 DPU of 6.45 to 6.61 cents will translate into 9.6% to 9.9% dividend yield. Yeah, that's all for SESR. I'll now hand over to Peggy. Thank you.
Thank you, Miao Miao. Morning. I'll talk about ST Engineering. We initiated coverage on them on this company last week. We have a target price of $4.50 derived from a discounted cash flow methodology. I'll go straight to the reasons for our recommendation. Okay, the Singapore government had raised their defense and security spending in the last 2 years by 12% and 17% in FY21 and 22 respectively. The budget for FY23 is still a growth of 6%. For ST Engineering, the total contract wins for defense was 5.2 billion in first half 23. The order wins and order book is on the chart, second chart, the lower chart on the slide. Okay. This order win for defense of 5.2 billion in first half 23 is about 21% higher than the whole of FY22. Currently, the order book stands at a record of 27.7 billion. Okay. The second segment for ST Engineering, the second biggest segment is commercial aerospace. We expect that segment to register very strong growth coming from the recovery in air travel, which will underpin the demand for maintenance service, maintenance, repair and overhaul for aircraft, engine and components. And there's still room to grow given IATA's estimates, which shows that air passenger and air cargo volume are still 9.7% and 20.3% below pre-COVID level. And Asia Pacific is playing catch up. We'll see that in some slides in the next few pages. And the third reason for recommending ST Engineering is the TransCore, which they acquired in March 2022, that we expect this acquisition to contribute positively from second half of 23. The TransCore is on itself is profitable, but after the higher interest expense and amortization of goodwill as well as integration costs, they were still in the rate at the EBIT level. So with the TransCore turning around for second half of this year, we expect the Urban Solutions and Satcom division to post a positive EBIT for the year. and yeah, a turnaround from the first half. Okay, I'll move to the next slide to show you some of the details. Okay, ST Engineering, the core business grouped into 3 segments. This is the FY22 pie. The defense and public securities accounts for 47% of total revenue. It's about still within the same share in first half this year and going forward in the next 2 years. The defense and this segment, defense and public security, has the highest EBIT margin among all 3. In fact, the EBIT margin has grown from 9.5% last year last year to first half of 14.2% as they divested the US marine operations. They closed down the loss-making business and so this 14% EBIT margin is sustainable going forward. So commercial aerospace also had maintained a margin about 10%. The urban solutions has been weighed down by the restructuring at the Satcom, satellite communication business. And the TransCore is yet to be earnings accretive. Therefore, it was a loss in first half, but we expect it to turn profitable for this year onwards. The next slide, please. Thanks. Okay, just a look at the Singapore defense budget, defense and security budget has been on the rise. If the increase has been accelerated with the heightened cybersecurity threats and the geopolitical tensions. Having said that, ST Engineering, they are a key defense contractor in Singapore. They also have some overseas defense contracts, but the scale is small in comparison to Singapore orders. And some of these orders are actually they secure prepayments. So the customers prepaid so that the revenue model, the structuring of the contracts is very favorable for ST Engineering. That explains why they could able to enjoy very strong ROE and returns on invested capital. And we track the order book over the years. It has been rising in tandem with Singapore's defense and security budget. So almost in line. The next slide, please. Okay, in terms of in the commercial and aerospace segment, the ST Engineering is a big players in the MRO market. In fact, the commercial aerospace revenue is almost double that of SIA Engineering, and because of they have many bases around the world. According to IATA, the passenger volume is even with the recovery in the air travel, reopening of the borders, they are still 4.5% below pre-COVID level in the month of July. The markets that opened later, like Asia Pacific, still have some room to catch up. For the air cargo segment, that we have seen the declines since the beginning of this year, but the decline has abated significantly. In the month of July, in fact, Asia Pacific managed a turnaround of 2.7% year-on-year. It's the first month of a positive growth, a year-on-year growth. So that it bodes well for ST Engineering's freighter passenger to freighter conversion business that they undertake with Airbus. Next slide, please. So this is a valuation for ST Engineering. The breakdown of the EBIT is will comprise mainly defense and security component, which is a big contributor to the earnings. On the difference between EBIT and net profit, the gap is due mainly to interest expense. High interest expense has gone up, has risen because of the higher gearing as they took on more debt. They bought TransCore for 100% cash. So there was no issuance of new shares. Therefore, net gearing has risen in FY22, but we believe that with the very strong cash flow coming from this operation, the net gearing has room to fall. And ST Engineering has always delivered a very strong ROE of above 20%. Even the ROIC is expected to recover after the pandemic to return back to the 15-16% in pre-pandemic level. And so at this level is very comfortably above the cost of debt, which the management thinks they can maintain at mid 3%, 3 to 4% in FY24. Okay, the valuations looks on the P basis looks high, but is comparable with the other global listed defense contractor. The key to recommend ST Engineering at this time is also because of the likely softness in the slowdown in the US market and the weakness in China. In Singapore's economy is also heading for a slowdown, and we think especially the institutional funds will want to pivot to something where it provides, it generates defensive earnings and good cash flows for the business, and which ST Engineering will stand out. So with the committed dividend payout of 16 cents per share, that's a yield of 4.1% for shareholders. Thank you. That's all for ST Engineering. I move on to Southern Alliance Mining for Philip on the ground. They released the results for year end in July. So they held an analyst briefing which I attended. Southern Alliance Mining is one of the two listed iron ore mining companies in Singapore. Their operations are all in Malaysia. The revenue is generated all from iron ore production, of which they have a 15.7 million ton of resource. They also have gold mines under exploration, so no revenue generated from that. And they're looking to buy 2 rare earth mines from their major shareholder. These rare earth mines are also in Malaysia. Okay, the reported gross loss of negative 1 million ringgit. That's because of a 26% decline in iron ore volume sold. And also in line with the decline in the market price for iron ore, the ASP fell 11%. They incur higher strip ratio of 9.1 compared to last year of 8.1 to remove the overburden from the surface. So and that means higher cost. In the gold exploration also incur costs as well as the due diligence for the acquisition. Okay, for Southern Alliance Mineral Mining as well as other iron ore mining companies, the revenue and profit really tracks the iron ore price. So the iron ore price is the chart below, which is very closely related to the China economy. It's almost like a perfect chart for the industrial output. Okay, the iron ore price up year to date is still down 1.5%. It's compared to FY22, it's definitely lower on the average, and 21 was a good run. We had a good run in iron ore price. The end consumer for iron ore is the steel industry, and China accounts for more than 55% of the steel output and consumption in the world. And then the end demand for steel goes to construction, autos, heavy machineries, and white goods. So not helping is the fact that China resumed iron ore imports from Australia this year, and that also exert pressure on the average selling price. So while they sell to the 3 local steel mills in Malaysia, the selling price track very closely to the global iron ore price. So therefore, we see could be further weakness going forward for the iron ore prices if the China property sector continue to languish. Okay, the Southern Alliance said they will begin underground mining in FY24, which means that we believe will jack up the cost of production. Okay. On the two rare earth mines that they plan to acquire, one is a brownfield, one is a greenfield. They will be acquiring this from the major shareholders. Valuation is still subject to the independent qualified professional report to be out this month or next. They will be issuing new shares for the acquisition, and then following that, they will need to do a compliance placement. Currently, the free float is 10%. They want to raise it to 15%. And they estimate that the placement will be about $90 million Sing dollars worth, which means that we calculate backwards, the acquisitions are valued at about 530 million Sing dollars. Because there is no resource numbers, so it's very difficult to tell whether what's the unit price or what is the cost per ton of output or per tons of resource that they will be paying. So the balance sheet has net cash of 9.6 Singapore cents per share. Of course, this is much lower compared to the last 2 years, as they collected the good cash flow during when iron ore had a good run, but over the years they have been depleting the cash. Okay. So comparing this with Fortress Minerals, also listed on Singapore Exchange and iron ore producer, we think Fortress is presenting a better picture with a more focused operations and a targeted effort to raise its output through increasing its resource for iron ore and possibly nickel. Yeah. Thank you. That's all for me. I pass it on to Zane.
Thanks, Peggy. I'll move on to the technicals. Okay, so for the S&P 500, from the chart, we actually rebounded from the main uptrend channel support. So, but currently we are still under the 4,330 neckline area where we broke down last week. So we could see a little bit of a range consolidation ahead. Resistance will be at 4,330 to about 4,380, while support will come in at 4,230 to about 4,280 area. Next slide. Okay, then we also looked at how S&P 500 tends to perform following a US yield curve uninversion. So the yield curve, as you all know, has been steepening lately. We saw the 10-year yield rising faster than 2-year yield, and it's at its closest to its uninversion since the banking crisis in March this year. So when you look at the chart slide, this actually shows the weekly comparison between the S&P 500 as well as the US 10 minus 2-year Treasury yield spread since 1980s. And highlighted in the red boxes are actually periods where we actually saw uninversion took place. So can see from the chart that there's generally an inverse relationship between these two variables. Yeah, next slide. So when we looked at the periods highlighted in the red boxes, we actually look at how the S&P 500 tends to perform 6 months as well as 12 months post uninversion. We found that excluding the 2019 data point, where the market actually saw a very big rally due to the stimulus, S&P has actually declined on average about 7% half a year, as well as 9% a year after this takes place. As well as when we delve deeper into the table, right, we can see that the index actually can decline quite substantially during these periods, where we saw about 11% drawdown in 2001, 6 months after uninversion, as well as in 2001, 2007, we saw declines of over 14% as well as 17% correction a year after this takes place. Next slide. Yeah, so looking at all the data, S&P 500 has a tendency to post declines when we see uninversion of the yield curve. And in every instance, this has led to a recession within 2 years, with about the median time about 16 months. Yeah, so one of the reasons why this yield curve can actually predict recessions because the market actually will anticipate the Fed to actually cut rates during a downturn. And then this will actually lead to the long-term bonds to rise to decline at a price at a faster rate compared to the short-term ones, because they're actually more interest rate sensitive due to the duration of the bond. So this actually causes the yield differential to increase and cause the yield curve to steepen as a result. Yeah. Next slide. So we also had our technical monthly for September. So this table actually summarizes the performance of the various asset classes, ranging from S&P, bonds, gold, oil, Bitcoin, as well as Singapore and Hong Kong equities. In general, most of the asset classes declined about 3 to 4% in September, with the standouts being oil, which was unchanged, as well as Bitcoin, which actually gained close to about 3%. Yeah. Then in terms of the current trend wise, about half of them are in downtrend, which are the S&P 500 bond as well as gold, while the rest are actually a bit of a consolidation. In terms of the outlook wise for this month, gold as well as Hang Seng Index could remain bearish if their prices continue to trade downwards. Then some range bound trading relief could come in for S&P 500 as well as bonds if they actually hold their near-term supports. Then as for oil and Bitcoin, there's some potential for upside if they actually hold their respective range and try to break out towards the upside. Yeah, so this is a summary. Next slide. So the first one we'll be looking at is the VOO. So for this, we actually saw from the chart that it's continuing its decline since pulling back from the resistance of the uptrend channel. Then in September, we actually tagged onto the uptrend channel support. So if we see some sort of support coming at this level, we could potentially see some of short-term rebound and some range consolidation take place for VOO. Next slide. Then next one, we look at the treasury bond. So this IEF is still currently trading in its downtrend channel. Last month, we also saw it break down the $92 level over there. Yeah, so for now, we could potentially see support close to $90 if that's the downtrend channel support, as well as the swing low created end of last year. So if that holds, we could potentially see some sort of relief for this bond ETF. Next slide. Then as looking at gold, looks like the downtrend is still continuing on. We had a retest of the broken uptrend support line last month. Then we actually continued to extend the decline by trading this downtrend channel with a lower low actually created. So there is some chance that this gold ETF actually extends decline, try and test the $36 level next, which is actually the downtrend channel support, as well as the swing low we formed at the start of this year. Next slide. And next, looking at the oil ETF. Last month we actually saw some range consolidation form following a very strong upward move after July. So it's actually just in a bit of a consolidation for now. But outlook wise, it's still leaning towards bullish if it actually holds the wedge consolidation support we saw as we've seen in the chart. Next slide. The next one is for Bitcoin ETF. So Bitcoin, we actually saw like support holding at the $13 level. We actually consolidated for a while. Currently, we are around the downtrend resistance line over here. So for now, there's a bit of a range could form, but some potential for upside if we do break above this resistance line and test the next resistance upwards, which is closer to about $14.50. Next slide. Then for Singapore equities ETF, last month, nothing much. We actually just consolidated a very tight range over here in the chart. Some resistance currently at 3.31 level, which actually broke down off and currently acting as a bit of a resistance. So I think for Singapore equities, we could probably still remain highly like this in a range bound pattern going ahead, as we are still not going out of this wedge consolidation for the time being. Next slide. And the last but not least, we have the Hang Seng ETF. So for this, looks like it's continuing on its weakness. So last month we saw a retest of the uptrend support line, and we actually saw rejection downwards. We tried and we tested the key support, which is around at the $61 to $62 level again. And during this process, we can see from the start of this year, we actually saw lower swing highs being created as we tested this support. So there is a chance for further potential downside if we don't hold this support level, which could potentially bring us closer to about $57 to about $58. Next slide. Yeah. Then the next one, we actually looked at the Thai SDRs. So monthly performance in September. So we actually have three of them, which are Airports of Thailand, CPO, as well as PTT. So in terms of their performance in September, it's quite a mixed bag. Airports of Thailand was down close to about 4%. CPO was down about 7%, and PTT was a bright spot. It continued its bullish momentum with gaining about close to about 8%. In terms of the outlook wise, I think in October we could expect some form of range bound trading for all of them. So for Airports of Thailand, it's actually because the price could rebound from some near-term supports. And CPO, there's also near-term support nearby. As for PTT, I think the range bound trading could come because of some sort of consolidation of its recent gains, since we have been seeing a very strong upwards move for this counter. Next slide. Yeah, so looking closer at Airports of Thailand, the chart wise, it's still holding up in the rising wedge. Then it's also in a range consolidation pattern. So for now, there's another what happened in September was another test of the support around $69 to $70. So this level must hold as a support for some bounce to come in. If not, there could be some there's a risk of a breakdown if $69 doesn't hold. Yeah. Next slide. Then for CPO, we actually had a pullback throughout the whole of last month, and we actually currently testing the one support level about $60.75. Yeah. So this level must hold to see some sort of a short-term rebound. If not, we could potentially see further downside to try and test maybe closer to 58.50, which is another swing low support. Since as a weekly chart, as you can see from the weekly chart start of this year, we've been forming lower swing highs throughout. Yeah. So that's there could be some bias towards the downside if the support doesn't hold. Next slide. And as for PTT, you can see from the chart in September, what was very nice was when we actually broke out the range consolidation, and we actually formed another consolidation range, and we created a higher high in the process and higher lows. So currently we actually tested about $173, which was a previous range support breakdown towards the end of last year. So we could see some form of resistance coming at this level. That's why you can explain the possible consolidation expected ahead for PTT. But the overall trend wise, it still remains in an uptrend for now. Yeah. Next slide. So moving on to the individual stock counters. For Singtel, we have a technical buy at 240, take profit level at 255, the stop loss at 235, and the stock last close at 242. So for Singtel, from the chart wise, recently, following the pullback, it has formed a double bottom formation at a $2.32 level. And recently there was a breakout as well as a retest of the 240 previous resistance level. So this has helped, so which means that there could be potential for further upside, supported by the bullish divergence we saw in the MACD's RSI indicators. So the potential target could be at 255, which is the previous support level we actually broke down off, as well as there's a price gap over there. And that could be confluent with the downtrend resistance line as well. Next slide. So for my last slide will be on ARM. So for this, could be a technical buy at $55.49. Currently, is at the stock last close at 53.52 on Friday. So for ARM, we have been there has been a pullback, but price has sort of started to trade in a sideways fashion. And last week we actually saw price try to break out above $54. So and as well as price actually held the 5-day moving average, as you can see in the blue line in the chart. So if this actually holds at a $54 mark, we could potentially see some sort of rebound in terms of the prices to try and test the $61 resistance over in the chart, as well as the $66 high, which was the day high on its first day of trading. Yeah, so that's all from me for the technicals. I'll pass my time to Paul to talk about the weekly. Thank you.
Yeah, thanks, Zain. So I'll just move on to our usual weekly updates on the macro numbers that were released last week. So for Singapore, we have a RevPAR, which is revenue per available room. So this is basically the hotel revenue. It's basically a hotel occupancy times room rate. So you get the blend between both, and it's an indication of the revenue growth for hotels. So for RevPAR, it was up 26% year on year, following up from also another very strong July, 28%. And with the F1 in September, you should expect another strong number. It's a record August month, and it's 17% above pre-pandemic. So just another sign that hospitality remains very robust in Singapore. We got IPI, which is industrial production. So this is just a gauge of manufacturing activity in Singapore. Continues to be sluggish, and electronics saw a 20% drop. We had our core CPI number. So this is important because this will determine MAS monetary policy stance, or what they think of the Sing dollar, I guess. So that it was up 3.4. It's within the MAS or below the MAS projection of 3.5 to 4.5. So that's trending well. So we don't, in the next few weeks, MAS will be probably announcing their monetary policy stance. So probably they'll just maintain the current status. We had some interesting news for Singapore population. So for the year ended June 23, we had a record number of additions to the population, about 281,000 to 5.9 million. The 5% growth that we saw in the population is actually the highest since 2008. Most of it came from non-resident that enjoyed a 13% growth. But in general, any jump in population is good for the Singapore economy, because it helps to grow the economy when your population grows too. For the US, we had core PCE, which is the Fed's inflation gauge. So that is up 3.9. The one positive thing is that it was the weakest month-on-month rise in more than 3 years. We will talk about it later. There was also comments by the vice chairman, which is the person most important after Powell, is the vice chairman. So he did mention that we are at or near the peak in terms of the interest rates. But he just has to maintain it. So it just seemed to suggest that the interest rates are likely to increase in the November or even December meetings. Another number that probably important for electronic manufacturers in Singapore would be the retail inventories in the US. So it's starting to normalize a bit. It's the slowest growth in 21 months. So we think there might be some inventory replenishment or better orders for the Singapore electronic companies. But for us, we are not very bullish. It's just that it's an inventory replenishment. It doesn't mean demand, because demand is inventory and also end consumption. So this one is just more inventory, and we are quite bearish on consumption for electronics. Next slide. So in terms of our tactical view, we all hear about all this US government shutdown news. Although it's been delayed for at least 45 days, and then we probably get it all over the media again. So just to get, this is nothing to do with the debt ceiling. So this is the annual, there's 12 appropriations bill. That means they have an annual budget on discretionary spending. So this affects the government's total spending, about 25% of their budgeted spending, which is discretionary and need to go through Congress to approve. The debt ceiling, that one was resolved a few months ago. So in terms of the impact of a shutdown, there have been 20 shutdowns since 1977. The longest was 34 days, and there was a study done, obviously not by me, but there was a study done that the impact of the 34 days was, I think, 0.02% of the GDP. So even though there's a shutdown, it's not really, doesn't really impact the market or impact GDP much. So I think, but of course, it's just all over the media. But in terms of the actual impact to the economy, is really hardly anything, because they might shut down some parks, maybe don't pay a few employees. But in terms of the overall impact on the economy, isn't that great. Again, so we are more confident that there'll be no more rate hikes because the inflation, we show chart later, is trending towards target. And we think it could, at this current trend line, it could even hit the 2% by middle of 2024. And then we think John Williams also, like I said earlier, he just suggested he seems to suggest there's a peak in interest rate hikes. In terms of the impact of the Singapore population, so it's positive for the entire domestic economy. I mean, any sector that is can be restaurants and anything, but it's also a driver for GDP, because GDP also depends on population. But I guess the two sectors that are benefiting the most, I mean, based on our conversations with all these corporates, is workers' dorm, of course, like Centurion's workers' dorm, because suddenly there's a huge influx of foreign workers, and LHN's co-living, because the population just increased, and most of these are non-residents. In terms of the events to watch, on 6th October will be the most important, because this is where the payroll numbers, unless we get some spectacular spike in payrolls, then we don't think this will waver the Fed in terms of change the Fed's mind in terms of raising rates. We have a webinar tomorrow by Centurion. Then on the 5th of October, I think that's Thursday, we have a SingPost too, and 4th we have the US company Marathon Digital. So feel free to join us if the time. And on the Saturday, we will have our usual quarterly strategy. Next slide. So in Singapore, we got two records. One is a record in RevPAR or hospitality. So it's a record August month. The chart on the left is the revenue per available room. And then the one on the right is the population. So the yellow line is the actual population that is other way. So we got 5.9 million. Then if you remember the 2019, we had the white paper. 2013, we had the white paper projection of 6.5 million or 6.9 million in 2030. So we haven't even hit the low case scenario. So if you want to hit the low case, we are probably about 100,000 off target. Next slide. Then okay, this is the US number. So we got some slowdown, but I guess we can call it quality slowdown because inflation is trending down. So the last reading is 3.9 in August, but if you just extrapolate, because month on month, you just take the last 3 months average and then you extrapolate it. By middle of July, you can actually hit the target or come close to 2.1. So this means that the good news is that it will mean that there won't be any rate hikes. The negative is that the real interest rates, I guess, if you're economist, is going to be even tighter. That means you're tightening the economy even harder with interest rates. Real interest rates. Yeah. Then the other thing is just the inventory. So you will notice the red line. This is the US retail inventories. So most of the corporates you speak to will say that electronic manufacturers will say that there's too much inventory in the channel. So you see the red line in 2022, there's a big jump, almost 20% to close to 25% growth in inventories. The pre-pandemic, you're normally looking, if you look at the red line, it's about 5%. So right now it's trending back to 5%. So the inventory overstocking has happened, but it is still high. I mean, the growth rate has slowed, but it's still high. You can see the blue bar there. It's still like record level of rates. So there might be some inventory recoveries by manufacturers. Next slide. Okay, so that's very complicated. So this is the Fed funds expectation. So this is the expectations by the market, the futures market, where interest rates will be. So the blue line is the current one. So the blue line is September 23. So you will see that November and December, the market is only expecting 4 or 5. So basically, the market is not expecting any more rate hikes in this year. Maybe next year you will get 3 rate hikes from second quarter onwards. That's what the market pricing. The green line was what the market was expecting interest rates to be in August. So the reason why I put so many lines just to show that why you see this huge rise in bond yields and the market also weakening is maybe because the market is repricing that interest rates will be higher for longer. By if you take, let's say, December 24, market expect interest rates, the Fed funds rate to be 4.6, but in August it was only 4.2. So the market is repricing upwards about 40 basis points. They think interest rates will be higher compared to where they thought it would have been. I mean, just 1 month ago. So again, that's why the whole market was a bit. The interest rate sensitive stocks were hit the most. Next slide. Okay, so this is our Week Plus is this is my last one before I move on to our usual review of the monthly performance. So this is just this company is a PVC pipe manufacturer in Singapore. Of course, none of us are interested in pipeware, but the main business is the medical device contract manufacturing. So they have 2 plants in China. So the earnings was down 55% in the second half. The table on the left is the full year. Of course, medical is the most interesting because they manufacture for like Johnson & Johnson, Boston Scientific. The revenue decline, according to them, is like I highlighted earlier, there's a destocking by customers. Amazingly, even medical customers also overstocked because of the supply chain issues last year. One thing good about this company is that they produce 92% of the products are fully assembled. So they are not a parts manufacturer. They actually fully assemble, they sterilize the product, and they actually ship it to the end customer. So this is a very, probably if any contract manufacturer want to enter medical, this is probably an acquisition target, I think. But they're used in surgeries. So these are very high-end products. It's like, okay, this is the, I don't know how to pronounce this, the laryngeal mask, but basically this is something you put into your, you want to because sometimes there could be things stuck in the throat for emergency, or you want to put anesthetic, oh sorry, you want to put medicine through the mouth, then so that there's no blockage. The other one is a spine surgery. This is actually injected into the spine, which I actually no idea how it works. But these are very high-end medical products that they do, even gene therapy. They have a vessel to store the cells before you inject it back into the body. Okay, then the reason they got hit because revenue was down because customer had too much stock, and secondly, was the expanded capacity in China. So you get hit both ways. The revenue come down and your expenses go up because they had new capacity and because customer deferred, so they got hit this way. And one last point is that they said in terms of the outlook, they say that any recovery they think is probably only 6 to 12 months away. Next slide. So to go through the usual model portfolio, so we were down about 0.7. The market was down 0.4, 0.5, so we were down 0.2. If you look at the portfolio, property is still hit us quite badly. Our CapitaLand Investment, CDL, Capital, and Propnex, all the property-related ones have hurt us quite a bit. Best performer is probably Comfort and some of the banks. Next slide. This is just an overall how the market performed, the Singapore market. So the table on the left is just a snapshot of some of the sectors that we break down. So the best performer was telecoms, mainly because of StarHub. If you look at the top, StarHub is up about 8.8%. Then finance also did well. Maybe DBS up 1%, I guess. But the rest, everything just went down. So the chart on the top 10 gainers is the performance. So I think a lot of commodity stocks did really well, like Rex is up 37%, Geo, the coal manufacturer. Then the losers were Manulife, Olam, I guess we all know what happened there. Then some of the REITs were hit, especially the overseas REIT like Cromwell, Tarsin, and First REIT. In terms of the gainers, these are the top, the STI gainers. So Dairy Farm was a big gainer, ST Engineering. The losers was Frasers Logistics, Seatrum, and so forth. This is just for your info and SIA. Next slide. This is my final slide. So we also just have a look at the various asset class. So Singapore was down 1.5% because of the weakness compared to the US dollar. And then the REITs was the worst hit. So the rate sensitive stocks were the worst hit, down 4%. Likewise for the bond ETFs, also down -3.9%. Best performer, if you want to call it best performer, is a commodity ETF -1%. This is just for reference to get a flavor. The US was down about 5 to 6%, depending on S&P or Nasdaq. Okay, I think with that, we can move on to Q&A. Thanks.
Maybe I kick off with the question on SIA Engineering and ST Engineering. Okay, there's a question that asks, any M&A prospect between ST Engineering and SIA Engineering, given the complementary MRO? Okay, maybe the answer is it's less likely now than before. Okay, not impossible, but much less likely so. From the valuation standpoint, SIA Engineering is valued at about, let me check my table. It's valued at 55 times EV/EBITDA for last year's FY23 March earnings. PE is about, excluding the cash, is 31 times. So comparatively, ST Engineering has a much lower EV/EBITDA as well as PE. So valuation wise, it doesn't work for ST Engineering. And SIA Engineering's aerospace business is now much smaller than ST Engineering. It's just taking out that commercial MRO business. ST's is about 1.7 times the size of SIA Engineering. Why ST Engineering has been able to grow while SIA has not been growing as much? It's because SIA Engineering has done like a key MRO contractor for Singapore Airlines. They have some third-party business, but with the COVID, when the COVID hit, most of the airlines were grounded their planes. So the demand for MRO has also reduced as especially for the aircraft portion. So in engine MRO, ST Engineering has started out with that and had an edge in the global market. The other reasons that why ST Engineering has been doing better is because they have so many more hangars located worldwide. Not just for MRO, but also for passenger to freighter conversion. So they have a lot of bases where they can offer the MRO service, and airlines like that because then they are able to get their MRO done wherever their planes they plan to land or just park for a short while, right? So with that many hangars that provides the flexibility for the airlines. And the recent few years, the trend has been for the emergence of a lot of travel on budget airlines. And budget carriers that tends to be looking for short turnaround time and convenient locations for where they also have their routes and where they also have the scheduled flights. Yeah, and the probably one last point is that the trend is also been going towards narrow body aircraft versus wide body aircraft. Narrow body aircraft because now especially for the budget carriers, they cater for a smaller number of passengers but to more designated location. So narrow body aircrafts are more in favor, and comparatively, ST Engineering has is a stronger foothold in that area compared to SIA Engineering. So with all this in mind, and plus that SIA Engineering has cash of 631 million is there in their books. So unless that cash is taken out, SIA Engineering had to be prepared to pay a lot for if they were to acquire SIA Engineering. And Temasek owns just slightly below 50% of ST Engineering. Unlikely they will want any change to their stake because they don't have a golden share in ST Engineering. So having a stake now below 50% gives them protects and considering that ST Engineering is one of the defense contractor. So even all this, sorry, it's quite a long way to say that I think it looks unlikely at the moment. Thank you. The second question I have is, hi Peggy, does the increase in Singapore defense spending directly translate to better performance for ST Engineering? Can MINDEF also acquire from overseas contractors instead of solely for ST Engineering? The higher Singapore defense spending, sorry, the other way around. ST Engineering order book for defense trends in tandem with the Singapore defense spending so far, right? Yeah, but it might not relate to that. The performance might not track, but the order book definitely is. But having said that, defense only account for about 2.8 or 2.9 billion of revenue for ST Engineering last year, considering that Singapore's defense spending was about 17 billion. So it's ST's only account for maybe just slightly more than 10% of the country's defense spending. Singapore's defense and home affairs are still sourcing a lot of items from overseas contractors. They also have other local contractors which are not listed, and so they are not limited to just buying from ST Engineering. Thank you. Maybe I hand back to the rest first while I look at the questions. Thanks.
Yeah, thanks, Peggy. I'll take some questions. Excuse me. With the high interest rate, what is the outlook for S-REITs? Yeah, so for our outlook for S-REITs, we note that a lot of the REITs sold down over the past 2 weeks because of the Fed's so-called higher rates for longer. So that will definitely impact the REIT market, as their fundamental business is to borrow funds to earn the rental income. But overall, we have a relative overweight for S-REITs. And then one step we look at is the price to NAV. So the price to NAV for the overall REIT market is now trading at about 0.9 times and is slightly below even pre-COVID, pandemic lows of the 2020 March. Yeah, so the price to NAV is below the pandemic lows of 2020 March. And as we all know, the price to NAV recovered like after the March 2020. So we also think that the price to NAV will recover in due time. But in the near term, we note that it's challenging for REITs, but we still have a relative overweight for REITs. But we also note that this higher interest expense that they will incur from higher rates for longer will affect their DPU payouts. So we do not expect much DPU appreciation or much increase in DPU payment for most of the REITs, with the exception of hospitality, because hospitality, with the improvement in RevPAR, a lot of the improvement in RevPAR revenue can more than offset the increase in the additional operating costs as well as the higher interest expense. So it's likely that only the hospitality sector can have improvement in DPU. Yeah, so that is our outlook for S-REITs. We still have a relative overweight because we believe in due time that the price to NAV will trade back towards its historical norm, which is slightly above one times book value. Yeah, now it's about 0.9 times. Yeah, there's one question. How do we get a copy of the slides? Is the video available at your website? Yeah, so usually after our presentation, we will upload the whole presentation on YouTube. So you on our YouTube, Phillip Capital YouTube channel, so you can go there and take a look at the replay. Yeah, we do not upload the slides specifically, but the video is there, so you can just pause and yeah. Any reasons why ESR sold down last week? Yeah, I don't see any particular reason why ESR sold down last week, but it's more of in line with the general REIT market sentiment, where after the Fed's stance of higher rates for longer, yeah, a lot of the REITs sold down over the past 2 weeks. Yeah, so I think it's more in line with the market sentiment. But one good thing about ESR is that they announced today that they managed to divest a property at about 35% premium to valuations. So this shows that the asset is an industrial asset in Singapore. I think it's Tuas, if I remember correctly. Yeah. So this shows that the Singapore market, the valuations are holding steady, and is the valuations in Singapore are still very resilient, and the demand is still there. Yeah, so we are not too worried about the valuations in Singapore. What are your views on F Fraser's Logistics Trust? Yeah, I don't really have a view on FLT. We do not cover them. I'm not too familiar with the share. Yeah, maybe I can do more homework. Then you drop me an email. I'll reply you. Yeah, sorry about that. Yeah, please comment on First Street. Yeah, so First Street, First Street, they after their restructuring in 2020, right now their leases are much in a better place, because first of all, now over time most of their rental revenue will come from Siloam, which is a cash cow, rather than Lipo, which is burning money and making losses. Yeah, so this is the first issue, like, because their revenue they collect from Siloam, which makes their lower risk of the non-collection of the rentals for First Street. Yeah, so yeah, and then back then when First Street when they did their rights issue, it was at 20 cents. And right now First Street is trading at around 23 cents. So it's around the price where they did their rights issue back then in 2020 when they did the restructuring. Yeah, but First Street's hospitals are that they're doing well. Like I think 3 of the hospitals are already on variable rent. Yeah. So that's my comment on First Street. Yeah, they are doing quite their strategy or rather their outlook has improved significantly since the restructuring of their leases. Assuming interest rates stayed higher for another year, which streets are more affected and which are less affected? Yeah, so all of the streets will be affected, and it really depends which I guess the REITs that are more highly geared will be more affected, definitely, as they will have to incur the higher interest expense for longer. And and it also depends on the hedging profile as well. So let's say if rates stay higher for another year, and then we see previously some of the REITs they hedge like higher, like 80 or 70% hedged previously to a low rate, so they'll be not as affected. But then if we see REITs that are less hedged, like 50% hedged, so they'll incur the steep increase in the rates or the higher interest rates on the floating portion. Yeah, and right now in this current market, we also are we are keeping a lookout on those REITs who are still looking to enter into hedges at this high interest rate. But I don't think most REITs will do that. But some REITs they target to have maybe around 70% hedge. So because of this so-called internal mandate or what you call it, yeah, their strategy to hedge 70%. So some REITs might still hedge interest their loans at these high rates. But I mean, this is detrimental to them, because like we hedge at these rates, and as interest rates come down, maybe next year or 3 years from now, then they're hedged at these higher rates. So we are wary, and we are keeping a lookout on these REITs. How is office occupancy rate and outlook for Singapore? Yeah, so for Singapore occupancy, office occupancy, the physical occupancy, okay, I believe is around 60%, but the overall committed occupancy is is quite high. It's over 95%, if I remember correctly off the top of my head, for the office assets in REITs like Suntec. I believe Suntec, maybe Mira can comment, but I think Suntec is 99.9% occupied for their office space. Yeah, so and the office rates, the rental sign in the previous quarter, it was at all-time high 11.85, but we believe that this rate will start to plateau and slow down. Yeah, because of there's the IOI Central Boulevard, there's a lot of supply coming up from that, about over 1 million square foot, if I remember correctly. Yeah, so all this and of course the weaker macroeconomic environment and the tech sector downsizing and such. Yeah, so all this will affect the outlook for and the rents for the office space, but we don't think that the office rents will decline that much. We think it will plateau around these levels of about 11.85 per square foot. Yeah. So that's my comment. Yeah, I think that's all for me. Oh, there's one more. Can you elaborate more on REITs interest rate hedging and how they're going to fare? Yeah, I think I explained a little bit. Yeah, so yeah, so basically, if you hedge previously, because previously, like when the rates are low, let's say under like the Fed rate maybe 2 years ago was at 0, right? So if you hedge a 3-year or 4-year forward, you kind of locked in that very low interest rate. Like you're only paying the bank margin, because the base rate is like super low. So if you locked in 3-4 years back then, you're definitely benefiting now because you'll still be paying like that maybe low 1% versus now the rate, the Fed rate is 5%. Yeah, the base rate. So yeah, you'll benefit from that. But if you did not hedge, then definitely you are paying high interest rates on the floating portion throughout. So yeah. So how are they going to fare? I guess if you hedge a high portion previously and for longer, you're going to do way better as compared to a REIT who's not hedged or looking to enter into some hedges now. Yeah, that is not too great. Yeah. Yeah. So I think I'll hand over the rest of my colleagues now. Thanks.
Hey, thanks, Darren. I'll take I think 2 questions for me. First one, OCBC share seems to outperform the other 2 local banks year to date. Do you have a reason for this? Yeah, you're right that it has outperformed the other 2 banks. I think it's the only one that has gone up for year to date at least. So for OCBC, if you look at all 3 banks just as an overview, I think if you look at their net interest income, net interest margins, and their fee income, these are the 3 main segments for the banks, right? It's pretty similar for the first and the second quarter. So, mainly the net interest margins have continued to rise due to the interest rates, and the net interest incomes have also risen. But the fee income actually was it reversed the increase, or the reverse the sort of improvement that they had in the first quarter and the second quarter. So that was a bit of we didn't really expect that. Allowances also have increased across the board for all 3 banks. So I think the only difference why OCBC has outperformed, I think there are 2 main differences. The first, 3 differences at least. The first one being, of course, OCBC is the most attractive price, at least, is the cheapest amongst the 3 banks. The second one is that they have the highest dividend yield at around 6.5, around that 6.5% for OCBC currently. And they also have not really sort of mentioned much about how are they going to lower their CET1. So moving on to the third point, which would be they have a very high CET1 compared to the other 2 banks. So if you compare to DBS and UOB, OCBC has not done any acquisitions. So for the DBS and UOB, they have acquired their Citibank assets, but OCBC has not yet. has not done any acquisitions yet. So it's I guess the public is, at least the investors are hoping or thinking that there's a chance they will further increase their dividends, which they did in the second quarter. So I guess we have to wait and see how much more they can increase it by in the fourth quarter. They haven't given any indication of that yet. No, and I don't think they want to also give any like false hopes that they will continue to increase their dividends. But even without increasing dividends, their dividend yield is also the highest. So these three main reasons are why I guess OCBC has sort of outperformed the other two local banks. Okay, one more on SGX. So please comment on SGX. I'll just do a very brief overview on SGX. The main highlights from their previous results were that for the main three segments, only their fixed income, currency, and commodities segment actually rose, and it rose by 32%, mainly due to continued growth in their commodity and currency derivatives volumes, as well as the higher OTC FX revenue, which is what they're concentrating on, and higher treasury income. So for the other two segments, which is the equities, cash and derivatives, as well as their data, connectivity, and indices, it was quite flat for the last results which they reported. But I think the main highlight for SGX would be that their treasury income rose by 177% year-on-year to 137 million. So I think it tripled for the full year 23 results. And this is mainly due to the higher yield on the margin balances, mainly from the higher interest rate environment. Maybe I will elaborate more on this. I think SGX actually they do have this collateral, or this float from collateral, so they call it margin balances, and they have around 12.6 billion of that, at least at FY23. And so they will put this they'll put some majority, or at least some of these 12.6 billion float into interest earning assets such as like fixed deposits. I think fixed deposits is the fixed deposits, and then they will earn this interest from this. And so this is where their majority of their interest income comes from. And there's a bit of a lag because they put it into like 3 to 6 months fixed deposit. So when the interest rates shot up that time, it wasn't in immediate effect. But now that they are sort of refreshing the interest on these floats, we can see that it's starting to kick in. So in the first half of FY23, we already saw an increase, but in the second half, we saw an even bigger increase. So currently it's now 137 million for FY23, and it represents 20% of their FY23 profit before tax. And so for the outlook, we do believe that there's even bigger upside in their treasury income, and with the potential to further increase with the current high interest rate environment. So why do we say that? Because in FY20, that was when the Fed fund rate actually peaked at 2.5%, and they reported an interest income of 135 million, which earned a yield of around 101 basis points. So comparatively to now, they are earning a yield of 109 basis points. But as you know, the interest rates, the Fed fund rate now is even higher. It was definitely not 2.5%. I think it's double that. So, if we go into the first half of FY24, we could see that this treasury income would jump even higher. Especially, it might even continue to jump in the first in FY24, at least for the whole year. Yeah. So I think that's all I have. Let me just do one more quick check. Yeah, that's all I have. So I'll hand it over to the rest of my colleagues. Thanks.
Yeah, okay, thanks. So I think there's quite a number of questions. Let me just try to answer some. Then high property and rentals continue to trend upwards. Do you believe we have averted recession? I think officially, I think one minister came out to say that there's probably no recession this year. So I probably don't want to argue with that too. I think I wouldn't say property and rental trend upwards. I think it's mainly if you do have the population coming in, it does help. Although the international trade is probably the larger part. And also we probably can see some recovery. We're already on the 12-13 month of decline in our exports. So the base effect so-called should see it improving. So we think there's a good chance that we will avert recession. and also the last time I think the last quarter the numbers did well because of the construction sector. So I think they can always just just award something more to just avert it. Yeah, so I don't think, and even if it does go into recession, I think that's not the. I mean, I guess for me, it's not the point. The point is whether is this slowing worse than the market expects. So even if you announce a recession, I'm not sure if it's a very mild -0.1, -0.2. I'm not sure the impact to the stock market will be that significant. Yeah, and in the end, probably the US, the direction of the US economy probably has a larger impact on the stock market and us here. I mean, just my own view. Any coverage on StarHub? Yeah, we do have a coverage on StarHub. We have a accumulate rating and a target price of 121. They recover strongly because the second quarter results was better than expected. And they also cut back some of their expectations because just to recap, StarHub was supposed to do this massive 300 million of spending to basically improve on their IT system. Of course, not just that, but it's also to improve on revenue opportunities, buy some EPL content. But they cut down some of the forecasts, so that should help. And they also announced a share buyback. So all this has helped the share price. And but we think moving forward, I think Singtel is probably the one that could also recover better if because I think Singtel, apart from most of their regional associates like India, Indonesia, and hopefully even the mobile prices are coming back up. What you also recently, they just announced they disposed of one of their loss-making companies, which is Trustwave, for I think a couple $100 million. I just slipped my mind. And they, a few weeks ago, they also announced they disposed of their capital. They disposed of their data center. So they're also doing this so-called Keppel mini-me kind of thing to dispose of assets, sell the sell stakes, sell some property, and then get a re-rating in the valuations and do a special dividend back. So I think I see Singtel heading that way. So they got two drivers for Singtel share price. Number one is the recovery in mobile. The next wave of recovery should be in Thailand too, because Thailand is going to stimulate the economy strongly. So Thailand, although they consolidated from 3 operators to 2, but there wasn't any mobile pricing, and so I don't know what's the point of consolidating. But one of the reasons is also because the economy is pretty weak, but with the new government and all the stimulus, that should also help their mobile prices there. So the only weak spot for Singtel is, of course, Australia. But I think directionally, both telcos also, I think, should improve in this current environment, especially when people are targeting non-cyclical industry, because we're heading for a slowdown. Okay, I think maybe I'm trying to look through, but Peggy, probably some are for you. You mentioned, okay, I'll answer this last. Paul, you mentioned co-living beneficiaries from population growth. Any comments on LHN? Yeah. So LHN gave an update to say that most of their properties are full, maybe 90%, 100% full. So I think for the second half of the year, the year end of second half of the year, I think they should perform well, the results, and they should have a special dividend because they just sell Asian Logistics. And the share price is still below their book value of, I think, 48, 49 cents. So I think they're just getting the slow re-rating, but as usual, this is their first year of very strong turnaround, and you see the co-living earnings, which is Collywood. They got like 40% market share in Singapore. So I think market just needs time to see if they can grow fast, grow even bigger, because this is their probably the first time you see a very strong turnaround. Last year was weak, then the prior year was strong because of some dorm business. But I think you need like another year of really strong recovery in Collywood. Then I think the market will re-rate them even stronger. But trajectory-wise, they are there because they already announced the additional 300-400 keys. So the new properties that they're building will also help the growth. But second half will be strong, then people will probably wait for a while to see how well, because it's only been the first 1 or 2 years of Collywood track record. So people are just a bit more hesitant, and they're still trading below. Paul, you previously mentioned you will invite Tiong Boon Corporation lunchtime, when they want to check if any response. We'll let you know by next week because I think we'll be having some meeting with them. Then we'll see if they want. But they have been more outgoing. They've been reaching out to analysts and investors because I think they're probably seeing some turnaround in the business from their overseas, Saudi Arabia, India, and of course Singapore. But we'll try and get back to you on the. But again, just my own view is that this is a very heavy balance sheet because Dongwon is a crane operator. But again, for a very short term, if the earnings turn around, of course, a good trade. But again, this is a very heavy capex. You lend your balance sheet out of business. But again, if there's a turnaround, there's a turnaround. But we'll try and get back to you on trying to get them for a webinar. Thanks for the question. Peggy, I'm not sure you got any.
Okay, thanks, Paul. I take over. Okay, there's a question on Sembcorp. Maybe I address that one first. Okay. Please comment on Sembcorp's Industries power purchase agreements today. Is it significant? Okay. Sembcorp Industries announced that they signed a long-term PPA power purchase agreement with ST Telemedia, the global data center unit. It's up to 100 megawatts for 8 to 10 years. So which means there's about on average about 10 megawatts a year. And compared to Sembcorp's capacity, that's about maybe 0.8% or 1% of Sembcorp's capacity. It's small in terms of capacity, but it's significant in the sense that we see the Sembcorp's locking in all the capacity to is a sign that the customers are getting are fixing in longer commitments. That's a good sign. The second thing is Sembcorp are able to predict its utilization and their price for taking in the feedstock, the gas feedstock. So it helps them to be able to more accurately project the spread that they will make from power sales. And Sembcorp says this will be accretive to FY23 earnings, which is this year. So in terms of volume, not big, but the agreement is significant in that we see not just Sembcorp and also Keppel also trying to lock in as much as possible longer term contracts on their power capacity, so to ensure that they have a guarantee of they have an offtake that is more or less I think that the target is to achieve at least 80 to 85% of the capacity volume being contracted. I hope I answered that question. Okay, the next one is okay, I think my question was missing. Okay, KIT's, this question is on KIT, Keppel Infrastructure. KIT's share price has dropped quite a bit recently. Is there anything alarming? KIT, as we recall, they are in the process of refinancing some of the loans. First is the loan for the KMC, Keppel Merrimau Cogen Plant, which they had to start advertising the loan this year. So the faster they can refinance that loan, the earlier they can resume the dividend disputable income and dispute that for KMC. So you recall from the second quarter of this year, the KMC's distribution has been suspended as they need to think about amortizing and repaying the loans that's due. So if they can refinance that, then they can resume the disputable income from KMC, which is about 44 million to KIT's unit holders. 44 million Sing dollars to KIT unit holders. The other loans that they need to think about is for the acquisition of a Marina South desalination plant, which they have been talking about acquiring that from Keppel. So they, I think they're in the midst of looking at the capital market to see, or the debt market to see if there's any appetite to finance this asset so that they can buy it from Keppel. So likewise, if Clarity could not do this, then Keppel will also similarly face some weakness from the inability to do the asset recycling through this exercise. Yeah, I think these are the two reasons why KIT is the price is weak. Thank you. Why is Seatrium no response to $500 million project? It's so it's not a 500 million project. It's a refinancing. They raised a sustainability link note for $500 million. If you're referring to the announcement today, yeah, this is if you recall after the first half results, I mentioned that they had about 2.4 billion or 2.2 billion worth of debts that are short term that needs to be refinanced. This forms part of it. So it's just a refinancing exercise. But given that refinancing this at this current interest rate environment, we don't think it will be cheaper than what they had earlier secured at. So I guess that's the reason why there was no reaction to the announcements. Thank you. Here's a question on, appreciate your comment on shipping industry outlook, please. Just a quick glance at the SCFI, Shanghai Composite Freight Index, which is almost which tracks the container shipping freight rates fairly closely, because Shanghai really is the key market where cargoes get shipped out to the big developed countries. Okay, the SCFI is now trading at 886, which is compared with slightly lower than 1,000 beginning of the year. So it's still declining. In fact, it was improving post-COVID reopening, but it dipped again and dipped a lot more in the month of September. So let's say this container shipping outlook is not really it's actually softening. For Baltic Freight Index, it had a sharp increase in the month of September, mainly because of the spike in the price of oil-related commodities like coal and even iron ore. The price recovered in the month of September. So this Baltic tracks the bulk carriers, which are used to carry these cargoes, to ship these cargoes in water. So therefore, the bulk carriers are enjoying a better time right now. But still, year on year, they're still lower than the average of FY22. Thank you. Okay, sorry, Paul. It says Paul and Tim, but I think I can address this. Any views on current crude oil above $90 on Rex, Dynamic, RH Petrol, and Seatrium? Typically, a stronger oil price will benefit, or in the sense that we expect the revenue to and the demand for the product and services to improve. But for these four, it affects to a different quantum. For Rex, by going through the announcements lately, you can find that they had already terminated their business operations or the plans in Malaysia. So Malaysia is now off the table. And by the announcements on Oman, so there seems to be some disruption in that oil fields recently, which might affect their output from the Oman plant or Oman fields. So for Rex, we have our reservations on whether they can benefit from the spike in oil price as much. For RH Petro, their oil fields in Indonesia are producing, and that the higher oil price translate directly into the higher revenue. So they will gain from this improvement in the oil price. But the cost of production has also risen. So and they need to incur a capex to develop new exploration and drilling activities. So therefore, it does not, it might translate directly into the revenue, but bottom line will still be impacted by this additional cost. Dynamic is a specialist in the floating platform, the topside platform for FPSOs and all the floating platforms. Has been enjoying very good order book, and they don't have enough capacity. They have outsourced some of this to Kim Heng, but we're not. We think that they should be. We think that the margins, the low margins actually presented some risk, in the sense that if the cost inflation would be would probably eat away some of these, will probably bite into some of these margins, and the thin margins does not justify the thin margins might affect the ability to bring in new businesses, as well as to generate sufficient cash flow to run a bigger order book. Right? And for Seastream, as I reiterated before, they had the debt that they need to refinance. They 2/3 of their order books comes from Brazil, and they had and we are also concerned about the investigation in the corruption case. So there's a lot more uncertainty, a lot more on the horizon for Seastream. So we think FY 23 might still be there might still be in the red, as they're still going through the restructuring exercise to consolidate the business that they had acquired from Keppel Offshore and Marine. Thank you. I hope I've answered the question. Thanks. Yeah, I think that's all I could do. Maybe pass on
Darren,
to
there's this Darren, there's this OXMU. I think this is Manulife and BTOU. I think that's Prime.
Oh, okay. Yeah, I missed that earlier. Where is it? Okay, never mind. I can't find a question.
Yeah. Okay. Let me just take this. Then we move on to the technicals. Hi. Any information or good news pertaining to IMF released the World Economic Outlook on 26 September? Yeah. Actually, we don't really concern ourselves. I mean, not say concerns. We don't really monitor that much IMF, because they'll probably just say GDP up, GDP down. Not much value add for us. They probably just look at the current trends and just extrapolate. Many coincidental indicators rather than leading. Probably the COP28, that means the new climate exchange meeting coming up in November. That's probably a bit more interesting, because that's going to be hosted by in Dubai. So I'm not sure what are the plans there. Maybe they might ramp up even more renewable spending. So that one probably the more interesting event to watch than this World Economics Outlook. I mean, from just my own view. Yeah. I think we hand it over to Zain. Yeah, thanks.
Sorry, let me just talk a quick one. Yeah, so let me answer a few last questions. There's one is CityDev recent acquisition of Japan residential assets. Plus or minus, I guess that's accretive or not accretive. Yeah, they didn't announce the yields on this acquisition, but we think it's accretive because of the low funding costs in Japan. Yeah, so highly likely it's about 100 to at least 150 basis points accretive. Yeah, okay, yeah, then regarding the Manulife or Prime, yeah, so there's no update for both Manulife and Prime. Yeah, but I'll leave the TA portion. But the issue is that there's another follow-up question, basically asking what's the amount of loans expiring in the coming year. Yeah, so for Prime, they have about 63% of their loans expiring next year. So that one we are on a lookout for that. Yeah, to make sure that hopefully they'll be able to refinance as soon as possible. Yeah, and not wait until the last minute. I think it expires in July for them, July 2024. Yeah, but other than that, there's no new news on Manulife and Prime. Yeah. Okay. Zain, please. I hand over to Zain now for TA. Thanks.
Okay, thanks, Darren. I'll share my screen for TA now. Okay, so first up is Asian Pay TV. So in terms of trend wise, it's still in this downtrend trend over here. Price has just been consolidating, still in the range. I think nothing too much for now, unless there's a breakout taking place above this 99 cents. Sorry, 0.099 cents. Sorry, 0.099 level over here. Yeah. Yeah, but there could be some more downside if this recent lows at 0.095 doesn't hold. And next support could be around 0.093 over here. Okay, the next one is CLI. Okay, for CLI, recently price did double bottom over here. Then some improvement in terms of momentum wise. So it'll be good if the swing low over here can hold, which is around 302 over here. Yeah, currently we are testing this broken this support previously around 310. So there could be some sideways trading over here first. Yeah, but if the lows, if the recent lows is able to hold, there's some potential for break above this downtrend resistance line. That could bring some further upside. Yeah, but for now, could be some sideways trading first. And the next one is Xpeng. Okay, Xpeng recently price just been consolidating, and there was it went up on Friday to retest the previous support around $71. So for now, there could be some resistance coming in at this level. Yeah, then support wise likely to come in close to about 66 to 67, this area over here, which was the most recent resistance. Yeah, so if we do form, let's say, a higher low over here, then there could be some chance for a reversal upwards. If not, likely just continue to sideways a bit. Okay, the next one, SIA. Okay, SIA, I think still trending downwards over here along this trend line. Next support wise, the next strong support wise could come in closer to 630, which was this range breakout in May this year. Yeah. Then another closer support for now will be this uptrend support line over here. And could we do a retest that might bring us to maybe about 640 over here bottoms. Yeah, so I think for now it's still in a downtrend, but some near-term supports could be some supports are nearby. We'd see a short-term recovery in price if we find support at these levels. Okay, next up is SETS. Okay, SETS looks like attempting a breakout of this consolidation wedge over here. Some resistance likely to still come in at this 262 to about 265 levels. But looks like some bullish momentum is coming back because of indicators and price action. So if let's say it can sustain a higher low over here, which is around 260, there's some potential for price to move upwards towards 270, the next resistance level. Okay, then for CDL Hospitality Trust. Okay, CDL Hospitality Trust, I think it's still consolidating in this descending triangle over here, support 103, resistance likely coming around 106, 108 over here. Yeah. So I think nothing too much for now. Probably still in this range, unless there's a break upwards or a break downwards. Yeah. Okay, the next one for CapitaLand Escort Trust. Recently price actually retested the lows at 96 cents over here. So still weak momentum wise. Yeah, but if the recent support hold, we could see maybe some range bound trading for now. With the resistance value coming around 97 cents to 97.5 cents level. Okay, then for AIMS APAC, as for AIMS APAC currently is retesting this 128 previous resistance support level. In terms of momentum wise, it's starting to show some signs of weakness. So if it doesn't, it is able to hold, or there's a chance that it could go to test the next lower support, which is around 124 to 125 over here. Yeah, but if not for now, likely to see some form of sideways trading between 128 to about 131 here. Okay, then next one is CICT. Okay, CICT, I think a lot of you, some of you have actually mentioned this counter. Yeah, showing some sign of weakness. Still continuing on in its downtrend over here. Recent breakdown of 186 also. Also, there's a potential breakdown of this uptrend support line over here if it's unable to go back above it. So currently, I think we are still in a bit of a sideways over here. There's a nearby support at 181. So I think price could just sideways over here for now first. And then next one is Mapletree Logistics Trust. Okay, Mapletree still pulling back from this wedge resistance over here. Currently tapped into this support at 155 over here. So in terms of downside wise, I think not too much for now. Likely to find some support even if 165 break, likely to see some support close to 162, 153. With this recent swing lows as well as this trendline support. Okay, then in terms of the three local banks, first up DBS, price wise held the retest over here, $33.20 level. And currently there was a bounce up towards to test the first resistance at 33.90. So could see some sideways trading if this resistance holds. Yeah, then nearby wise, near term wise, there's likely to come in some support at 35, 33, 50 cents over here. And then next up for OCBC, I think OCBC in terms of chart wise, looking not too bad. Momentum wise, you're seeing higher highs as well as higher lows. And in terms of the chart wise, there was a retest of the resistance at 1290 again. But looks like along the way we are forming higher lows over here with this trend line. So there is a chance that, let's say, price is able to consolidate over here for a while. There's a chance for breakout take place. Near-term support could be around 1270s Yeah. And for UOB wise, UOB still not as strong. Breakdown of this uptrend support line. Near term wise, there's some resistance like coming around 2860s to about 2880 over here, which was a prior support resistance level. So could just trade sideways for now. I think the recent support around $28. So 2820 is likely to hold. Okay, then in terms of the TA for the Manulife as well as Prime, okay. Is it consolidating or bottoming? Okay, let's look at the charts. Okay, so for Manulife, there was a last week there was a break of this wedge over here. And then in terms of the indicator wise, you're picking up in terms of momentum. Then currently you are retesting some. Also the good signs is that from this series of lower highs we've seen, we finally saw a higher swing high being formed. So yeah, there is a chance of some form of consolidation or reversal taking place. So currently likely to see some resistance up from a retest of all the prior breakdowns over here. So near-term resistance side today we tagged to one at 0.063. The next one will be at 0.07 over here. Then near-term support likely to come in at 0.05, 0.054, 0.055 this level here. So if price can able to sideways and form a higher low, then there is a chance for some reversal to take. Okay, then next one, Prime US REIT. Okay, Prime recently looks like a double bottom taking place over here. Currently testing the neckline resistance at around the 14 cents mark over here. Yeah, so okay, this is also accompanied by increase in momentum. So if price is able to hold at higher low, then there's a chance for some breakout to come in the near future. Let's see whether it happens. Yeah. Okay, next one, STI index seems to break out from heads and shoulders formation. Okay, for STI, I think STI likely to see some resistance still, but I think like you see some resistance ahead because of this after we broke down this uptrend support line over here, and also with this breakdown of 3240, we haven't actually retested it. So I think in terms of the strength wise, it's still some weakness. There's still some resistance close to what 3230, 3240 level. But the support is still coming in from this 3200 swing low to this recent sort of double bottom over here. Yeah, so likely you see some form of range bound trading still, I believe. In terms of the head and shoulders, if you're referring to this one, then I think he hasn't fully formed yet. If there's some continued downside, then there's a chance for a breakdown next time. Okay, the next one, AEM. Okay, AEM still rebounding a little bit from the recent retest of the supports at around 330s over here with this trend on support. So yeah, could see some range bound trading in the time ahead. Near-term resistance likely to come in close to resistance likely coming close to 350 over here, which was this breakdown that took place. Okay, the next one, iFast. Yeah, okay, iFast I think starting to show some signs of weakness with this. Previously mentioned there was bearish divergence taking place. Yeah, and price actually just there was a false breakout above 590 and price came back down. Then another development was this breakdown of this uptrend line support. Yeah, so some signs of weakness coming in for iFast. Maybe perhaps if the downwards momentum continues, potentially test lower supports around 550 over here. Okay, then for Franken, I think it looks like it's still holding up well. So after the retest of this downtrend resistance line breakout over here, price looks like it's breaking out of this consolidation triangle over here. So looks like there's still some strength to perhaps retest the recent highs, which is around 114. Then also the next resistance level previously was around 116, 117 as the next level. Yeah, so looks like Franken is still holding up well. Okay, please comment on Genting's share price. Okay, for Genting, I think there still is probably still some weakness for now. Maybe if it's able to hold its recent low, then maybe we do some sideways trading over here. But last week we still form a lower low over here. Yeah, so for now, some near-term resistance at the 86 cents level, then followed by 87 cents. In terms of indicator wise, there's still some upon the formation of the lower low, there's still lower low form indicator. Yeah, so no divergence for now still. In terms of moving averages, also still below the 20-day as well. So yeah, no signs of no immediate signs, no clear signs of a reversal yet. Maybe you see some sideways trading first. But the trend wise, I think yeah, still looks weak for now. Okay, next one, okay, Alibaba. Okay, recently, got some support around the $84 over here. So potentially, if this holds, maybe we go and test this resistance again, close to $88 and or $89. We have this downtrend resistance line over here. So this is a near-term resistance. Okay, then for JD, JD is still bounded by this downtrend resistance line. Also no divergence signals yet. Yeah, so unless there's a breakout taking place, then potentially there could be some relief. If not, maybe some just sideways for now. Near-term resistance could come in close to about $30, 40 cents, $30 50 cents is the next level. Yeah, then AMD a rebound from this wedge support, tested the resistance over here. And near-term resistance wise, if it does a breakout, there's still some near-term resistance at 108 perhaps, which was a prior support term resistance over here. As well as it was a prior uptrend channel breakdown as well. Yeah, so for AMD, if you want to see a proper reversal, maybe you see a high a test and perhaps a higher low form close about 102, 103, then there's a potential for it. Okay, next one, TSM. Okay, TSM recently finding support from the $85 level here, prior resistance acting as support now. In terms of the RSI, recently did like a double bottom. So yeah, looks like some rebound could take place. Maybe we go and retest the support breakdown over here, $89. Yeah, which is also, there's also this downtrend resistance line coming. Okay, the next up is CDL. Okay, for CDL, I think recently also we tested recent lows at around 655 over here. Yeah, then looks like some picking. Momentum wise, there's some looks like picking up a little. So if it's able to hold at this price, there could be some sideways trading for now. Near-term resistance is still the recent 660 for this level over here. Okay, then for Gokuland, I think still nothing too much. We are still very obvious in this range over here. So near-term strong resistance still close to 157. We have this horizontal as well as this downtrend resistance line. So unless there's a breakout above it, then I think not much development in terms of the chart price for Gokuland now. And then ESR REIT. Last week, there was a breakdown of this about 29.5 cents, 30 cents level. Then price, I think, just sort of sideways for now. Also retested a prior low over here, which was in October 2020. So the support around 27 cents. So I think for now, if this holds, then maybe we just continue to do some sideways. Then if it goes lower, then the next support could come in at 26 cents. If it's based on this trend line over here, if we test this trend line. Okay, Phaser Centrepoint Trust, I think currently some weakness in our share price because it's still in the range. General trend is a range. But the reason for the weakness is it didn't hold the 220 level over here. So after breakdown, there was a retest and subsequently price came back down again. So potentially there could be it could go on to test the support zone around here with around 213, 214 these levels for now. Okay, then BYD. Okay, BYD looks like possibly pulling back in this channel for now. Yeah. Then some near-term support will be possibly at 232, 233, this prior resistance over here. So let's see, possibly consolidating in this flag over here. Okay, next one, how is Yangtze chart up and down fast? Yeah, I think possibly a consolidation triangle. Yeah, maybe previously the one I draw was very good. But I think recently there is some signs of weakness in terms of the price action wise, where we see that retest of the support. First, we have a retest of this 175 over here, this double top. Recently, the test of 165 only brought us to about the high of 170. So that's a lower low created. So for Yangtze, the 165 needs to hold. If not, there's some possible downside ahead. If not, likely to just continue sideways for a while, because maybe between 165 to 170 these levels. Okay, next one, UOL. Okay, UOL did like a double bottom recently. Then let's see if price is able to maintain above this 30s level, potential for some sideways trading or bounce. Since the momentum is going upwards for now. Okay, then for Hong Kong land, nothing much now. Yeah, it's still in this range over here. Yeah, still in this range. Resistance, yeah, 365. Okay, next one, Lendlease. Okay, Lendlease. After the test of the support and 54 cents. Yeah, recently we tested again. So let's see whether it's able to hold at these levels over here. That could potentially be a double bottom, if there's some support coming in. Yeah, then the momentum also showing some uptick. Yeah. So let's see whether it's able to hold. Okay, next one is Parkway Life. Okay, Parkway Life, I think nothing too much for now. Still the the general trend, yeah, still sideways in this range between 350s or about 380s over here. Yeah, then recently there was a break below this support at 370. So potentially maybe just a consolidation is lower bound over here. Yeah, I think it's about one. I'll just take the 3 remaining questions over here. I'll try to finish it up. Okay, so for Keppel, okay, Keppel looks like today retesting this recently broken support. So let's see if it's able to break a hole in the range of and break upwards, then there could be some, it could go on to see like $7 over again. And for SEM Industries, recently priced, I think, a down bottom, 506 over here. General trend wise, still a range for now. So yeah, in terms of momentum indicators, a higher low has been formed. So yeah, there is a chance for another test of the recent resistance at 524, 525 over here. Okay, then for Hopper, I think the uptrend in this stretch is still intact. We're still seeing higher highs as well as higher lows. Recently just formed a consolidation range. I think for now, nothing much unless there's a breakout towards upside of $10, then potentially see 20 again. Okay, last one I'll do on Samudera. Okay, Samudera, I think looks like it's still sideways over here. So they managed to break above 76 cents over here. So we just decided to just trend in this range between 71 cents to about 76 cents. So yeah, it looks like a trading range for now. Yeah, so okay, I think that's all from me. I'll hand back the time to Aaron to close the session. Thanks.
Yeah, thanks. So let me just try to address the last few ones. So there's a question on Genting. So for us, I think fundamentally we think they should report some good results coming up in the third quarter, especially with the return of the tourists from China. I think you can just imagine they probably had no gamblers from China for the last 3 years. The poor thing, but the issue for us is that we think the price might, even if it recovers, it might just go back up to the pre-pandemic levels for Genting, about 93 cents. Because again, we just have this view that casino gambling is a very matured industry. The growth is quite limited, but you get this reopening bounce and return of so-called pent-up demand. So that's our view on Genting. This question: what counters will benefit from impending GST hike? Speaking of course, indirectly they get the benefit because the government's giving GST voucher, like Sheng Siong. Speaking to corporates on the ground, the only ones that could maybe benefit is maybe they were holding back on the first hike. Then now that there's another second hike, there's more room for them to increase price. I'm referring to companies F&B companies, not something like Old Chang Kee, where they can supply food that is more affordable, and then they have room to increase prices incrementally, because under the so-called cover of GST, so you increase 10 cents, 20 cents. People can understand that, because they might think of it like a GST impact. Just two more things. I think for Manulife, I think we highlighted before, for Manulife US REIT, our own view, at least my own peculiar view is that, of course, it's trading at 80% discount to book. But for Manulife, you're not taking a risk on whether the office market is down, because it's already 80%. You're just taking a risk right now whether will the banks call the debt on them. So they cannot pay dividends because there's this debt that they defaulted on the conditions, modest default, but again, it's still a default. So they have to renegotiate. Step one is to renegotiate with all the banks, maybe to raise the LTV. If that happens, then you get a few cascading impact. So secondly, if they do that, then technically their current liabilities, the banks will go back to long-term liabilities, then they can actually pay dividends. So that's the main thing. And then after that, the second consequence of that is that the parent sponsor can now come in and buy off one of the assets that's up for sale that they're looking to sell to sponsor. So you're more or less taking a bankruptcy risk thing about. Of course, this is under Manulife. So in a way, I won't say you got it covered, but you have some protection that's Manulife. And if the bankers also have no reason to default them, because it's quite a soft breach, and if they sell off this, then they can actually get repaid better, because the sponsor can come in to buy. So that's my own view. And one last thing for First REIT, the question on First REIT is that First REIT owns hospitals, so there should be no issue on the demand for hospitals. It's just that you're taking on Indonesia rupiah risk. Although they protect you by giving you a minimum 2% rental hike, but you have this rupiah risk that you have to take into consideration. That's it. So with that, I'd like to thank everyone for your time and for your questions, and sorry for dragging it a bit longer past the 1 p.m. Anyway, thanks everyone, and do look out for our webinars and our strategy event this Saturday at 10 a.m. If you do have the time, please register, and thanks again for your attendance and for all your questions. Thank you, everyone.